Hello, everybody, and welcome to the Unlearning Economics stream. I'm really excited today because we've got Frances Coppola with us, who is an economist, a former banker, and she's also a long-time member of the economics blogosphere. So her and I have been talking about economics and having exchanges, especially about monetary policy and finance for a long time. I'm really excited to have her on the show. So thank you very much, Francis, for coming on.
Pleasure.
So
These could be fun.
yes, I'm sure it will be. So what I wanted to use as the focus today was your 2019 book, which is called "The Case for People's Quantitative Easing," and I think the title is almost self-explanatory, but we can also use it as maybe a bit of a launching point to talk a bit about finance and monetary policy and how it all works, because it's extremely complicated. I feel like I have one hand grasped on how it all works, but definitely not both. And every time I think I've got it figured out, I get a little bit more confused. So to start with this, we've had what's called quantitative easing across the world for a long time. Let's say QE, otherwise it's going to be a bit cumbersome. But so QE was supposed to be the primary response to the 2008 crisis, the 2008 financial crisis, and then for a long time afterwards. And you really start your book by arguing that we've basically got this policy wrong.
Mm. Yeah, absolutely. I think, I mean, QE's actually been used even longer than that because the Bank of Japan was the first to do it. I mean, in its current form, in the aftermath of the 1990 Japanese banking crash. It used it really in the early 2000s because Japan never really recovered from that. It's had like 2 decades of stagnation, and so it embarked on QE really to try and get its economy moving. That was before the financial crisis. So you could say that after the financial crisis, the West, America, the UK, and eventually Europe, adopted a monetary policy approach that had already been tried by Japan and not worked. I've always found that a little bit bizarre. But it seems to be based upon the idea that if you throw lots of money at financial markets, somehow it will trickle down into the main economy. Um, and to some extent, it does. But my argument is that it doesn't do it nearly well enough. You have to do an awful lot of QE for it to have any noticeable effect on anything. It is knocked off course by fiscal policy if you've got a government that is determinedly stamping on fiscal brakes at the same time as the central bank is doing QE. QE becomes ineffective, really. And it has unfortunate distributional consequences, which is actually one of the reasons why it's ineffective, is that it really gives money to people who have assets. And the problem with people who have assets, they're rich, aren't they? They don't have a great deal of need to spend that money in the real economy. So what they actually do with it is buy assets, and that pushes up asset prices. So QE works through portfolio adjustments, through wealth effects. Um, Not a great deal of trickle down. I think the idea was that it would reduce businesses' borrowing costs. So they would borrow cheaply and invest, and that would generate jobs and incomes and so forth. What they actually did was buy back their stocks because it was a whole lot cheaper to have debt than it was to have equities. So they bought back their shares with the cheap um, borrowing that they could do because of QE. It was really quite a weak and ineffective policy. And my argument is that we could and should have done much more direct stimulus of the economy, and that should have been led by central banks in the sense that central banks control the money supply, central banks create the money, um, but that the distribution of it has to be done by fiscal authorities. And so, actually, monetary monetary stimulus of the economy actually needs to be a joint effort between central banks and fiscal authorities, that this kind of separation of monetary and fiscal policy that's been um, in orthodox macroeconomics really now for about 40 years is actually mistaken.
So
I think that's a fair
QE.
summary of my book,
Yeah,
isn't
no,
it?
that's a very good summary of your book. Yeah, which I read just recently in preparation for this, and I do have to recommend because I think it's a really clear explainer of the policy of quantitative easing and how it works. I mean, so QE is often referred to as printing money, right?
Mm.
That I think that's the popular perception of it, and I was just wondering, so central banks they print money all the time, right? And they create money electronically these days. It's not necessarily actually printed. So what was the difference between QE and what central banks just do generally?
Okay. I mean, I think the perception of it being printing money comes from an earlier age when we didn't have the electronic reserves for banks that we have now. There's been a sea change in the way banking works. And the heart of this is all about how banks work. Um, that whereas if you looked back a century, banks would hold physical reserves of currency, actual notes and coins, and they still do to some extent because they need to fill their ATMs. Um, but and if a bank ran out of physical reserves of currency, then people couldn't withdraw money out of their deposit accounts. So the um, central banks printing money could give that money would that money would go to banks, and then banks would have more physical money that they could physically lend out. And so the idea was that quantitative easing, printing money, if you call it, would stimulate bank lending. It became quite apparent really quite quickly after the financial crisis that it doesn't actually work like that anymore. And partly that's because we've moved away from this physical reserves of currency held by banks, apart from the reserves needed for ATMs. Most bank reserves are electronic, and they are a form of money that is really only used between banks and central banks, and it's used to settle payments. So when you withdraw something from your deposit account, um, uh, or you make a payment from um, your current account, checking account, as they say in the United States, then your bank makes a transfer of reserves to the bank that you're making that the bank where the person you're making that payment to banks. And then that bank will put money in that your pay's deposit account, um, and that's all electronic. It's all very different from this idea that you have to have physical reserves of currency. Nobody's transmitting physical reserves of currency anymore. Um, so um, and banks, because we have central banks, because central banks can create reserves at need, and because banks can borrow and lend reserves to each other, we don't have this kind of um, there's no direct relationship between the quantity of reserves that banks hold and their ability to lend, as there was like a century or more ago. Their ability to lend was governed by the quantity of physical reserves they had available, not least because if they needed any more, they had to get them by horse and cart. We aren't there anymore. We are in the realms of instantaneous reserve transfers from other banks, or from markets, from central banks. It doesn't work like that anymore. So the idea that creating lots more bank reserves, basically stuffing banks full of reserves, would increase bank lending turned out to be quite wrong quite early on, after the financial crisis. And then economists moved on to, oh, maybe it works on wealth effects and portfolio effects and these kind of things instead. Um, Even now, if you read documentation about QE from, say, the ECB or the Fed, they will still talk about it increasing bank lending, despite the fact there's no evidence that it does. Throwing money at banks, electronic money at banks, just doesn't make them lend.
Yeah,
Um,
yeah. So
it's
we I mean we have what is sometimes referred to, or I have seen referred to, as like a two-tiered money system, right? Where basically, if you imagine your own bank account, your bank deposits, you have like kind of normal money, right? It's pretty much exchangeable everywhere. But banks have their own bank accounts at the central bank, and those are in deposits. Sorry, those are in deposits. Those are in reserves, right? And that's a different type of money. So I guess it's a bit like kind of you're increasing with through QE, you're increasing this type of money, the amount of this type of money. But the problem is that money only has a very limited use, and unless the banks are short on reserves, then it's not really going to affect things, because it's a bit like saying, I don't know, here's UE, here's some money, but you can only use this in your house with the people that live with you, and you can only trade it within there, right? It's restricted in scope, the reserve. So there's not really a reason that expanding it is necessarily going to have a knock-on effect.
Exactly that, yes. In theory, you would think that if banks have lots of reserves available to them, then they would increase their lending, because loans mostly are paid away. I mean, if you borrow some money, you're borrowing it because you want to spend it broadly, although there are exceptions like refinancing for a loan, for example. Um, but the problem with that is that it's so easy for banks to get reserves. Um, they can borrow reserves on the interbank markets or the repo markets, or as a last resort, they can borrow them from central banks. So there was never really in the West a reason to stuff banks full of reserves. It was um, it was never really going to have significant effects on their lending, because actually what makes banks lend really is when the return on the loan is greater than the risk of taking it on. Yeah. Banks, if you think about what banks do, they take deposits on which they pay one interest rate, and they lend at another interest rate, and they pocket the difference. That's essentially the model of banking. It's unfortunately sometimes talked about as banks take deposits and lend them out, because it's not actually what happens. But there is that relationship between the price of the deposits, the funding, and remember, I'm using the term deposits quite broadly here, because banks don't just use deposits for funding, they use other things as well, like money market loans and things like that, market funding and bonds as well, and their own equity, which is part of the funding mix. The cost of funding um, needs to be lower than the cost of lending. The difference between them is known as the net interest margin. And banks really like that to be quite large, because that's how they make their profits. When that's squeezed too much, they start to become quite unprofitable. But against that, you've also got to put the risk of lending. So in an environment where they can where the risk, from their point of view, the risk of lending has gone up a huge amount, as it did after the financial crisis, right? Um, and the spread between borrowing and lending has come down. From their point of view, it may not actually be really in their interests to lend, and particularly, and in addition, when they're being dumped on by regulators to say you've got to de-risk your balance sheet because you took on far too much risk prior to the financial crisis, and it all went pear-shaped, didn't it? So you've got to cut your risks, you've got to have more equity, you've got to reduce your risk-weighted assets. You've got that, and you've also got the fact that after the financial crisis, it wasn't just banks that were over indebted and had suffered a real shock to their net worth. It was households and businesses as well. So everybody was deleveraging like crazy. And when everybody's deleveraging, nobody wants to borrow. So throwing money at banks is not going to make them lend, because nobody wants to borrow. The banks don't want to take any more risk, and nobody wants to borrow any money. And that's kind of where we ended up after the financial crisis. So QE, based upon the idea that it would make banks lend, was always on a hiding to nothing. It was more a question of whether it worked through other channels. And my argument is that once you're into the it's got to work through other channels situation, then really you're talking about an extremely weak tool. And in my view, it would be better to make actual transfers to households and businesses, or to allow the government to do that and fund them. And that was the argument in my book, that a much more powerful form of stimulus, and we would need much less of it, would be direct transfers, one way or
Yeah.
another.
Absolutely. So I think we'll definitely spend a lot of time talking about like what form the people's QE could take. I just want to get a little bit more into the plumbing of how exactly it worked, because I think one of the issues we have is that, you know, a lot of people don't really understand the financial system, and so some of their critiques, while they may come to actually the same conclusion as you, which is basically, what wait a minute, the central bank creates money and just like gives it to asset holders and in financial markets and things like that, why can't they give it to ordinary people? I think it's worth knowing some of the details of this and how it works, and I guess also what the rationale for it is, before we advocate that. So one other question I had, so when you were talking a lot about quantitative easing, is actually a really broad term, isn't it? Right? It's encompassed a whole range of things across since 2008 and before in Japan, and you know what I mean. It's really changed. And you said that we've established the bank lending channel doesn't work. It just increases reserves. Banks are awash with reserves already. Reserves can't be spent in the same way as normal money. It's not necessarily going to help. But there are other types of QE which have expanded, and central banks have directly bought sometimes corporate bonds or like private assets, right? And you were talking about these other channels through which QE
Yeah.
might work. So what exactly are these other channels, and why are you even more skeptical of them, seemingly, than you are of the QE increasing bank lending?
Yeah. What we normally think of as QE is actually more accurately known as large-scale asset purchases. And the moment I say that, it should be apparent, although we've come to think of QE as being central banks buying their own government's debt, it doesn't have to be. They can buy their own government's debt, and they do, but they don't necessarily have to buy that debt from banks. They could buy it from investors, and when that happens, the way the money transfers, where it goes, is slightly different. So rather than just creating reserves for banks, which is what happens when a central bank buys assets from banks, if the central bank buys assets from non-banks, from investors, um, then money goes into the deposit accounts of those investors. And that money is actually created by commercial banks and is the equal and opposite pair, if you like, to the reserves that the central bank creates. So we end up with if we say we have a bond that the central bank is buying from a pension fund, then at the end of the transaction, at the start of the transaction, the pension fund holds the bond, and the central bank hasn't yet created any money, so there's no reserves and no deposit, right? But at the end of the transaction, the central bank holds the bond. The bank that settles the transaction, that intermediates it, because all financial transactions ultimately go through banks, has reserves to the value of the bond, and the investor has money in their deposit account to the value of the bond, and that money is created not by the central bank but by the commercial bank that intermediates the purchase. The problem with this is the nature of the people they're buying the bonds from. The people who own assets, and they said what I'm described could be a government a government bond, or it could be a corporate bond, or it could be equity. The Japanese central bank was buying shares in some kind of quasi state-owned enterprises. There is no particular reason why a central bank shouldn't buy any of these things. What matters is who they're buying them from, and what kind of effect the balance of what they're buying has on market pricing for those things. So if they're buying assets from non-banks, then what we call M1 or M2, broad money, increases. And that should stimulate the economy more effectively than just increasing bank reserves. Because if you increase bank reserves, you're relying on banks increasing their lending, and they aren't necessarily going to. Whereas if you've increased M2 directly, then you might expect that the people who've received that money would spend it. The problem is who you're buying the assets from, because you're not by and large buying financial assets like bonds and stocks from people who have a high, what we call marginal propensity to spend. They've already got all the money that they need to meet their needs. They have no particular need for any more money to spend. So what they do with the money that they receive when they sell their assets is they buy more assets. So one of the things we saw in QE was that central banks would buy government debt from investors, and the investors, and remember this includes things I talked about it there as if it's a person, a high net worth individual, but it could be and often is something like a pension fund, and a pension fund is not going to buy much in the way of kind of consumer goods. So what you're trying to do is raise CPI inflation. It's not going to go anywhere. What they're going to do is buy other assets, right? And that's exactly what happened. So investors sold their safe assets like government debt to central banks and shifted into riskier assets such as corporate bonds and equities. And so we saw the prices of corporate bonds going up and the prices of equities going back up. The period of QE, the 10 years or so during which we've had QE somewhere in the world the whole time, has been arguably the biggest run on financial markets, biggest bull run on financial markets in history. And it's all driven by QE. And particularly in the last 2 years, actually, since 2020, we've had an absolutely massive run on all forms of assets. The prices have headed for the moon. It's all because of the amount of money that central banks are pumping into financial markets. And my problem with that is that all you're doing is pushing up asset prices. Yes, there might at the margin be some wealth effects that'll make people spend a bit more. They might go and have a few new kitchens or something.
Is that wealth
Um,
effects like when the
yeah,
price of your house goes up or the price of your stocks go up and you're like, oh, okay, I can spend some money.
yeah, but I mean that depends on your liquidity, doesn't it? Okay, so you've got a house, but it doesn't mean you can draw any money from it.
Hmm.
Um,
It's a very weak channel. I think I feel like
yeah,
a lot of the evidence suggests it's a pretty weak channel.
yeah, the wealth effect channel I think
Hmm.
is pretty weak. And I also think that the portfolio effects one is, I mean, okay, so it did depress because the yield on a bond is the inverse of its price. So as the price goes up, so the yield goes down, and that feeds through into the interest rates, the coupon rates on new bonds, because you can set your coupon rate on a new bond according to what the market yields are on
Hmm.
existing bonds, broadly speaking. So it did depress the cost of borrowing for corporations and even for households. We have had very low interest, and it's partly because of direct action by central banks, cutting interest rates right to zero. But it is also because of QE, because what QE does is rather than depressing short-term rates, which is what interest rate policy does, but actually depresses interest rates along the curve. So it flattens the yield curve. So instead of your yield curve looking kind of like that, it ends up looking like that. So your longer term interest rates are not as far above your short term rates as they normally are.
But this
Um,
is this supposed to encourage lending by the corporations as well? Then
it's supposed to, yeah, it's supposed to, it's kind of supposed to encourage long term borrowing.
yeah.
Because
Sorry, yes,
obviously,
I meant borrowing.
yeah, yeah, it's supposed to encourage long-term borrowing. Um, and also it also pushes up equities. One of the weird things we've seen in the period of QE is the positive correlation between bond prices and equity prices. It's not supposed to happen. They're supposed to be the other way around. Because bonds were safety plays. So when bond prices are rising, equity prices are which are equities being riskier.
Well, because there's
Um,
just so much more money in the system.
there was just so much more money around, and
They're both moving in the same direction.
people were just buying riskier things because the
Hmm.
money had to go somewhere.
Yeah.
It's when you've got all that money in the system, it's got to go somewhere. It doesn't stay as money.
Hmm.
I mean, some people were sitting on large amounts of money in deposit accounts, um, there was a period during which some asset managers were using actual cash as a hedge. But you have to remember that cash is only cash in deposit accounts is only safe while it's up to an insurance limit, and then above that, it's not insured. And so you're better off in something like gilts,
Mm.
which have unlimited guarantees.
Yeah, the
Um,
insurance limits. What's that, like $250,000 in the US? I think I
in the
can't.
US,
Yeah.
and 100,000 euros in the Eurozone, and 85,000 in the UK. And that is per customer per institution.
Oh, it's only 85,000 in the UK. I mean,
Yeah.
not that I'll be exceeding that anytime soon, but that's much lower than the US.
Yeah. Yeah, it is. Yeah, it's actually. I mean, it was actually the same. It was meant to be kind of the same as the Eurozone, but allowing for exchange rate differences.
Ah,
Only
okay.
exchange rate differences have, but the insurance limit doesn't change as often as the exchange rate. And also, we've left the EU, and now nobody wants to bring us into line with the
Oh,
EU,
for God's
with the
sake, yeah.
ECB.
Let's not get started on that just
Yes,
yet.
no, so yeah, the kind of the world's changed. But yes, the deposit insurance limit in the US is much higher. And actually, for a period after the immediately after the financial crisis, it was unlimited. Um,
And
they decided that everybody's deposits just really should be saved, whereas in Europe we've taken a rather more robust attitude to rich people's deposits, really.
oh, that's interesting. I didn't realize that. There was a period where there was unlimited deposit insurance in the US, but nowhere else.
No, not as far as I know. I don't
Okay.
think the ECB ever lifted the insurance limit, as far as I know.
And it
And the
changes
UK
cash's.
certainly didn't.
Yeah, it changes cash's status as a safe asset as well, doesn't it? When once
Yeah,
you go over that limit, then yeah, that's why people are basically not holding on to their money that they've got from this process, and they're buying bonds or equities or anything.
yeah,
So yeah.
that's partly it. And the other reason is that cash was a zero yielding asset. They couldn't earn any money on it. It wasn't safe, and they couldn't
Mm,
earn any money on it. Why would you hold it?
yeah.
Uh, so it became a bit of a hot potato. So everybody was so these investors were all getting this money and then unloading it as fast as they could into something that was a bit riskier, but would actually earn them some yield. We had a real reach for yield thing going on for years, and it pumped up all sorts of things, including in the immediate aftermath of the financial crisis, commodities, so oil and foodstuffs, actually all got pumped up, and I think that's kind of happened again a bit. Although I don't think QE is the main cause of the enormous rise we've seen in oil and gas prices and foodstuffs, but I think it is a
Mm.
contributing factor, just as it was after the financial crisis. We kind of forget that inflation touched 5% in the UK in 2011.
Yeah. So do you? So it's interesting because I think there's a lot of debate over whether QE causes inflation, and the basic idea is the simple idea that inflation is too much money chasing too few goods and
Mm.
services, and you've written about this in the book and you've written about it elsewhere. This idea of inflation, and it is basically, I think that's a basically correct, that if you state it fully. Whereas I think a lot of people state it and they only hear the too much money side, and then they forget that there's actually like another side of that. And I know you've written about that recently, actually. Um,
Yeah.
so, but are you saying that you think some of the relatively high inflation, 5% doesn't seem like that much now, but it was the highest it had been in a while in 2009, 2010,
Yeah.
in the UK. Do you think that some of that is attributable to QE?
Yes, actually, I do. Because at the time, in 2009, 2010, really until the first part of 2011, we actually had expansionary fiscal policy as well. We didn't really start putting the brakes on until towards the end of 2010. Um, and so um, there was a lot more money. And there was also a major pullback on the supply side. And I think the most important thing here is the same as we're seeing now, that a lot of this money that was going into financial markets that didn't really have anywhere to go, one of the places it went into was commodities. And when that happens, if new money is only going into financial assets like bonds and stocks, then you have a boom in asset prices, but you don't have a great deal of pass through into consumer inflation. But if it goes into oil, gas, foodstuffs, then you do. Basically, because any country that is importing those is going to pay higher prices for them, and that's likely to feed through into higher consumer prices. So, to that extent, QE did and does cause inflation
Mm.
when the money that goes to investors is going in going in certain directions, when it's going into commodities and foodstuffs, the kind of things that feed through into the CPI inflation, then it does. I mean, it's fair to say that central banks like to exclude foodstuffs and oil and gas from their inflation calculations because they can be quite volatile, and this is quite a good fudge, isn't it? But if it but nonetheless, what people perceive and the headline rate that central banks always get that the press always focuses on is actually what's in the shops, not the fudged version of it the central banks use. Um,
Which is understandable because people
yeah,
actually have to buy food
because it's
and
what
eat it
people
for
are
the
actually
price it's at.
paying.
Yeah.
Yeah, absolutely. Yeah, it is.
So,
So yes, I
sorry.
do think that QE did cause some inflation, and what the kind of inflation it caused was not the kind of inflation that we really wanted to see, because inflation that's caused by sharp rises in commodity prices is actually economically depressing. Whereas what we wanted to see was more money going into corporations, into businesses to generate jobs, to increase wages, to get people spending. That's what we wanted, money to reach the real economy. So that it could stimulate, so that people could spend, so that businesses could invest, so we could get the supply side moving. That's what we wanted. We wanted that in the aftermath of the financial crisis, and we still need it now because the supply side post-COVID is extremely bad. It's really badly damaged. Um, but that wasn't what we got. What we got was a fast rise in commodity prices, which pushed up inflation, but actually depressed the supply side because businesses got to pay those prices. It's actually the opposite of what we want. And I think sometimes when central banks are targeting inflation, they actually need to look at where the inflation's coming from. What kind of inflation is it? Is it inflation um, that is generated by a vibrant economy where there's a lot of spending going on that potentially could that means people are earning more, people have more jobs, the unemployment rate is falling. um, we're starting to see some labour market tightness, and that's driving price rises, because that's the kind of inflation that central banks want to control, versus the kind of inflation that is entirely outside anybody's control, because it's all imported and everybody just has to pay those prices, and businesses pass them on to their consumers if they can, and consumers cut back on discretionary spending because they've got to pay the prices of essential goods as well. And that's actually really unhealthy for an economy. Um, and I'm not convinced that with QE we've necessarily understood that difference.
It's really interesting this notion of inflation as something that's actually multifaceted and not a generalized phenomenon, because it does seem that for too long central banks have just pursued this like 2% inflation
Yeah.
or 1 to 3% inflation, and it's like, well, as long as it hits that target they're doing their job. But then what you're saying is basically, okay, but is this because of a rise in the cost of necessities like food and energy, or is it a sign of a healthy sort of
Yeah.
growing economy at full employment, which you get some generalized inflation when you're at full employment, right, and when you've got
Yeah.
economic growth. But when you've just got just got specific things that people need going up in price, you might not necessarily have that growth, especially if, I mean, we look at the energy crisis now, which, for the record, I think neither of us are attributing entirely to QE. We know
Yeah,
there's something, there's a lot going on in the
much more
world.
going on than
Yeah,
that. Yeah.
but you know, some businesses are looking like they might have to shut down without support, right? And then
Yeah.
that's not, that's kind of bad inflation, isn't it? Is the type of inflation you're talking about where it's bad for the economy. So we really need to be a bit more um, specific in how we think about inflation, I guess. I mean, just this is a bit of a segue, but I suppose, are you in favor of the kind of the inflation target that central banks have now, or would you prefer something a bit more multifaceted or different?
Yeah, it's a good question because I actually, it sounds terrible of me. I actually think it's become um, a bit of a sacred cow.
Mm,
Um, and there's a fair degree of bullying of central banks that goes on from markets and particularly actually from the press. Um, no, oh, inflation is this high? They must do something, ignoring what the target actually is, which is hitting inflation at that level over the medium term. It doesn't mean, oh my God, inflation is 8% this month, we've got to get it down. It's about saying what is the path of inflation over the next few years and where do we expect it to be? What are inflation expectations telling us? And that's a bit of a black art in itself.
mm,
Where do people expect inflation to be in, say, 2 or 3 years' time? And it's that central banks are trying to manage, not what inflation is from month to month or week to week, or but unfortunately, where we've ended up is everybody's reporting inflation figures almost in real time. And then we've got these knee jerk reactions to them. Oh my goodness, it's hit 8%. The Fed will have to do something. That's actually today, right? The inflation print from the US was higher than people were expecting. Oh my God, the Fed will have to raise
mm,
rates. Well, you need to be looking at the trajectory. Where is it going next? Not where is it now? Because if you don't, then you're taking too short term a view. So one of my problems with the inflation target as it's kind of popularly understood um, is that it's too easily interpreted as a short term target. And part of the reason for that is that the principal tool used to manage it is short term interest rates. Because people actually, I think, quite find it quite hard to understand how short term interest rates can influence longer term inflation.
mm,
And although kind of macroeconomists go, oh well, of course sure, if you influence short-term interest rates, then that feeds through into longer-term interest rates because it's all connected, it's all the same curve. In the end, everybody scratches their head and go, really? Why do you think that? And come up with all sorts of examples of cases where long-term interest rates have become quite disconnected from short-term ones. And macroeconomists, like famously Milton Friedman, didn't really have an answer for it, for that particular phenomenon. Said something vague about housing and pension funds or something. I can't remember what he said.
My audience will be happy with you slagging off Milton Friedman.
I'm very happy to slag off Milton Friedman. That said, I mean, I use his famous quotation myself. I was busy rewriting it recently. Um,
I remember, yeah.
I'm also quite happy to slag off Alan Greenspan too for similar reasons.
uh, so yeah, I mean, with quantitative easing, just returning to quantitative easing, how would you like to see a QE policy that didn't hopefully have these effects on increasing commodity prices, maybe increasing inequality, and ultimately not having an effect on where we wanted it to? What kind of policies would you like to see?
Well, interestingly, since I wrote that book, we've had the COVID pandemic, And central banks and governments in the COVID pandemic really did pretty much everything I'd said. And a lot of it was successful. So central banks actually have been backing their own governments' fiscal expansion, fiscal support to the economy. We've seen that everywhere. And it has been broadly successful. It did mean we got a fast rebound from the pandemic. In the case of the US, they also did helicopter money, which is something that I recommend in the book for when you're coming out of a recession. So in the COVID pandemic, we kind of had two stages. We had the stages when we actually had this extraordinary engineered shutdown of the economy, deliberately shutting it down in order to control a public health emergency. We can argue about, people argue to the death about whether lockdowns were necessary and what their effects were, but that's what governments did, was shut down their economies forcibly. Um, and the job of fiscal policy at that time, and supported by central banks, explicitly supported in many cases, was to provide enough money directly to households and to businesses, although that was to a lesser extent and to my mind not enough, to keep them alive. So to give households the means to live as their jobs evaporated, and to keep them in touch with their jobs as well, so that they had jobs to go back to, and keep the businesses alive as well, so that people did have jobs to go back to, if you see what I mean. So that was a lot of what, certainly in Europe and in the UK, was government policy during the pandemic. The US took a slightly different approach. Um, they didn't do so much to support, to keep people attached to their jobs. They actually let an awful lot of people lose their jobs, and they only intervened quite late when they realized actually this was really quite damaging and they had to do something. So a lot of the focus was actually of fiscal policy was actually the extension of unemployment insurance, which was hugely important. Um, but they also did helicopter drops. And the first one actually was done at the height of the pandemic in 2020. And I said then that I thought this was a mistake. Now, remember, this wasn't all that long after I published this book. It was published in the States in September 2019. And there I was in April 2020, like 6 months later, saying, actually, this is a really bad idea, having recommended it in my book. But my argument was that it was being done at the wrong time. So we'd got this engineered shutdown of the economy, and what we were needing to do was keep people alive, people in touch with their jobs, businesses on ice, mothballed, so that when we could open the economy, they could kind of pick up again. But instead of that, what they were doing was dishing out money to households, and central banks were pouring money into the economy in the name of stimulating demand. Now, it always seemed utterly nonsensical to me to stimulate demand at a time when you were deliberately suppressing demand because you were shutting down the supply side. It made no sense. And on the face of it, it was going to be inflationary. The only reason it wasn't inflationary was that actually people couldn't spend this money, so they stuck it in their bank accounts. So we saw the savings rate go up massively, and we also, of course, had people who were drawing salaries and because they were working through the pandemic and not working from home and not able to spend. So we saw the savings rate go up massively, and then as the economy reopened, we saw the savings being spent into the economy, and the US then did a second and third helicopter drops just as the money was coming out from the first one was coming out into the economy, and unsurprisingly caused inflation. I would have thought this was fairly obvious that this was going to happen. My view is that when you've had a shock like that, I mean, the COVID pandemic really was an unprecedented GDP drop across the world. It was an extraordinary drop, but not for very long. And when you come out of that, you some inflation is bound to happen, because when you've supported incomes like that, your people, the spending is going to recover, the demand is going to recover before the supply, and so you're going to get some inflation, but that should act as a pull factor on the supply side, encouraging it to beef itself up, to hire more people, to invest, and eventually the supply demand should equilibrate and your inflation should fall back to normal. That's how it should have worked. Um, but I think it's quite and helicopter money can help you do that. It can actually be a little bit of a demand boost that can act as that kind of pull factor on the supply side, and that's kind of why I advocate it. Um, what I don't think helicopter money should be used for is just as a substitute for fiscal support for welfare policy to keep people alive. Which is how the US was using it, and I did feel it was going to the way they were doing it in the wrong amounts and at the wrong time, was likely to cause inflation, cause more inflation than we would have had, just from an inevitable supply and demand imbalance and supply chain disruption after the financial crisis. But that is the US. I don't think that's the same in Europe, and I think that because Europe didn't do helicopter money like that. Um, and so, although we've had inflation in Europe as well, it's been more to do with this supply demand imbalance and damage to the supply side. And so, my other point, which I've been making since, is that I don't think in the pandemic enough attention was paid to supporting businesses. They did kind of hand out some loans, but loans aren't necessarily the right medicine. Um, and it was all a bit too late as well. So we did see a lot of businesses closing. Um, and we've now also had recruitment difficulties because things like the furlough scheme actually didn't support people's wages fully. So when you're dealing with people on minimum wage, if you've got a furlough scheme that is paying 80% of their wages, then they are living below the minimum wage. And so lots of them actually in the hospitality sector, that was the case, and in the care sector. And so lots of them left the, the sectors where they were being paid 80% of the minimum wage and went and got better paid jobs doing delivery driving and in the health service and other type of essential jobs. And so these sectors that were paying the minimum wage and lost a lot of their staff are having trouble recruiting. So these are all not to do with monetary policy. You see, I'm talking fiscal policy here, aren't I? And you know, labour markets and things like that. And in the end, I think that's actually with crises like this, that's actually where the action is. And one of the things I talk about in my book is the fact that actually fiscal policy is way more powerful than monetary policy. Um, Helicopter money really is a fiscal policy. The money is produced by central banks, but it's delivered by governments, and who governments deliver it to is a fiscal decision. It's a political decision, and how they deliver it and to whom
Mm.
affects inflation, because you know if they make it indiscriminate, um, rather than carefully target, it will probably be more inflationary. And interestingly, if they target it more towards the lower end of the income distribution, it will be more inflationary than if they give it to rich people. If they give it to rich people, it will push up asset prices. If they give it to poor people, it will raise inflation.
Okay, that's interesting. So you kind of anticipated my next question, which was going to be about inflation, and basically, whether this kind of people's QE would create inflation more so than traditional QE. You call it QE for the banks in the book, right? Versus QE for the
Yeah, it was a
people.
bit unfair, but QE for financial markets, yeah.
Yeah, for financial markets, yeah. Um, and what you're saying, if I understand correctly, is that basically the support offered to people that was kind of equivalent to like unemployment benefits and things like that, while not perfect, you had some criticisms of it, was a decent idea given what was going on.
Mm,
But these kind of one-off stimulus checks that were done, especially in the US,
mm.
that they were something which actually was inflationary and essentially, in your terminology, almost took QE for the people a bit too far, and wasn't something that we should have pursued. Is that right?
More or less. I mean, like I said, I do actually advocate helicopter money in my book, but I do think you have to be very careful how you use it because it's
Mm.
extremely powerful. If you use it at the wrong time and in the wrong amounts, you will cause inflation. In fact, you might say that the purpose of all of this is actually to raise inflation. That is the purpose of QE. If you're doing people's QE, it is still the purpose to raise inflation, but kind of the good kind of inflation, or actually more accurately, I mean, I suppose you would say the bad kind of inflation, really, the inflation that comes from having a vibrant economy that is reaching full capacity, done correctly, it should increase spending, and that should encourage the supply side, and the inflation should calm down, right? But if you overdo it, you will end up with too much money chasing too few goods, and so supply side won't be able to recover. And I think that won't be, and so you will end up with higher inflation. There is a case though for saying, yeah, to what extent should we look through supply side inflation? I've argued really since we started to come out of the pandemic and the inflation from base effects, and the overshoot on oil prices before the Ukraine war, and supply chain disruption, all of that um, all of that helped to fuel inflation through various routes. Um, and there is an argument that that kind of inflation that comes from supply side factors should be ignored because it will resolve itself. If you support demand, it will resolve itself because eventually the supply side will heal. You know, if you've got disrupted supply chains, eventually businesses will find alternative suppliers. um, Shipping will start to come down in price, as indeed it did. I mean, one of my favourite charts over the last year or two, has been the Baltic Dry, which is a measure of the cost of shipping, and it's very interesting. It going rocketing up like a church steeple and then coming down again,
Mm.
which was kind of what I expected, because often these supply side price spikes can be quite short lived. I don't. What was not anybody's radar though was a war, and when you're in a wartime economy, the whole thing works differently anyway. Wars are inflationary always.
Mm. Yeah, so I think it goes back to what we were saying about inflation being multifaceted as well, isn't it?
Mm,
Because currently you've got central banks across the world increasing interest rates. Now, as I understand it, I mean, nobody really says this out loud, but the primary mechanism through which this works is to reduce people's disposable income,
yeah.
and therefore reduce demand. And that's often done through mortgages and other home uh, related costs. And it, it has effects on other markets as well. But I think it was Josh Mason who wrote a really interesting blog post about how construction is actually the sector that's affected the most by this.
Mm.
So what do you think of these moves to increase rates? Do you think we should increase rates at all? Do you think they're too hasty? What level do you think rates should be at? And if central banks, I guess, aren't going to increase rates to manage inflation, then what else can we do other than wait? And you did make a compelling case for waiting, but I'm guessing you might have
Mm.
some other ideas in mind too.
Yeah. I mean, it's all very political, isn't it? So you've got the press insisting that we've got terrible inflation and central banks must do something. So of course, central banks must raise interest rates. And it's actually quite hard for central banks to say no, we're not going to do anything because this will resolve itself, and say to fiscal authorities, over to you. Um, because this is supply side inflation. This is raising people's costs of living. This is terribly raising costs for businesses. If you raise interest rates into that, then you're just making that worse. And so what you're going to do, if you're not careful, is actually cause a recession. You've already got an elevated risk of recession because of these rising producer prices and rising consumer costs in essential goods. I mean, nobody can escape from energy bills, um, which is going to depress discretionary spending, and that does trigger is recessionary. Um, and to that, you're adding increasing people's mortgage costs, increasing borrowing costs for businesses. You're adding to the price pressures. It all looks extremely pro-cyclical to me. And it's all, I think, because of the short-term view that says, oh my goodness, we've got high inflation. And it's not taking a slightly longer view that says, although we have inflation now, the underlying trend here is recessionary. it's entirely possible to have inflation and recession at the same time. We've seen that before, actually. The last time was in the 1970s, and the reason was much the same. We had a war.
Mm.
And I find it remarkable that people don't see that a war involving oil producers and food and global food producers is going to be globally inflationary. It must be by definition. When this happened in 1970, in the 1970s, we had the Yom Kippur War in 1973, and the oil embargo imposed by the OPEC oil producing states on the United States for supporting Israel and kind of by extension the United Kingdom as well. And so we saw this sudden spike in oil prices, which added to the existing inflationary pressures that we already had, um, to create, I mean, in the end, in 1975 in the UK, inflation that touched 25%. Um, and although we already had inflationary pressures, the icing on the cake, if you like, was the war in the Middle East. And so here we are again. We already had inflationary pressures because of the supply side, supply demand imbalance, um, from uh, from COVID, supply chain disruption, and base effects as well. It's interesting that people look with shock horror at very high fuel prices now and forget that in 2020, um, fuel prices crashed. That in the UK we could buy um, petrol, what the what the Americans call gasoline, at the pumps for below £1 a litre, which had been for the first time since the early 2000s. And people forget that because we couldn't fill up because we weren't allowed to go anywhere. So nobody, hardly anybody, the only people who knew that the prices had crashed were people like delivery drivers. Now, um, people are using cars again and so forth, and we've got disruption, we've got spikes in um, global oil prices, things like that. Suddenly, oil prices, of course, massively rebounded. Oil producers had cut production, and that took a while to recover. So the price shot up too much, and then we had a war. Um, and the question is, how should central banks react to that? And my view on that is that they shouldn't react to that at all. That these kind of supply side disruptions, if you add to um, the pressure on household and businesses from import caused by rises in global fuel and food prices, it's all very pro-cyclical. Um, you're just making matters worse. The question really is the extent to which the fiscal support and the monetary support, the helicopter money and so forth that was done during the pandemic, and people's ability to save during the pandemic as well, when and then this saving, is fueling inflation. And there was, I think, in America, some evidence that it was, and therefore in America, I supported raising interest rates, um, because I did think there was too much money floating around for the reasons that I've already given. Um, I'm not convinced that that's the case in Europe at all. What I do think all countries need, actually, and this has been my thesis throughout, really, is that the purpose of people's QE, really, you could say even the purpose of QE, any QE, is to give cover for the fiscal authority to do what is necessary to support its population, to support its businesses, and to pull economies out of recession. What we had in the aftermath of the financial crisis was a brief period of expansionary fiscal policy and then a massive retrenchment as everybody got scared about the levels of debt. Particularly, I think, because of we were seeing the beginnings of the sovereign debt crisis in Europe, and people hadn't at that time fully understood how very different the Eurozone structure is. So we looked at Greece and we looked at Ireland, and we thought, oh my goodness, if we don't pull back on our sovereign debt, we're going to go down the same path. And politicians that were keen on small states um, thought, yeah, this is an opportunity for me to push through my ideology. And a few academics helped them do it by issuing really very flawed academic papers.
To say the least.
There were a couple of them. I mean, there was Rogoff and Reinhardt, of course, with the
Mm.
famous mistake that wasn't discovered for several years. But it was also Alesina with the expansionary fiscal austerity, which turned out to be all based on an Australian case study, which when you actually looked into it, none of it actually, it hadn't actually had that effect at all. Um, I mean, there are a few examples of things that could be regarded as cases where fiscal austerity has had unexpected effects, has unexpectedly restored um, an economy. And one that I might think of would be Latvia. Actually, in the aftermath, Latvia took an absolute hammering in the financial crisis. It suffered a GDP drop of 25% in 1 year, and it had to be bailed out by the IMF. The IMF wanted it to at the time it wasn't in the euro, it had its own currency called the lat, which was pegged to the euro, and the IMF wanted it to devalue the lat to encourage exports, to help its supply side, have you devalue the lat. It's the Washington consensus approach, and Latvia refused. So no, we're going to hold our peg. We want to join the euro. Um, and they took it on the chin. They took this massive GDP drop, and then they bounced back. And it turned out the reason that they bounced back was that because they were pegged to the euro, and there was a nice little carry trade developing between Sweden, the Swedish krona, and the euro, and the Swedish banks could lend quite nicely could borrow in krona and lend in euros in Latvia, and make quite a lot of money. So they blew up lending in Latvia and pulled up the Latvian economy. And then thereafter, um, the European Commission kind of held up Latvia as this poster child for fiscal
Mm.
austerity, and it was actually all because of this euro kroner's carry trade. So it was all in the end about monetary policy.
That's really interesting. So I think there's a lot to talk about there. I mean, one thing is that with increasing interest rates, right? A very simple point to make, and this is a mainstream point, is that monetary policy actually has quite a lag on it.
Mm,
It can be, I don't know, it can be anything from 6 months to 3 years, or maybe even longer. If you study it for long enough,
mm,
you'll probably see effects much further down the line. So when
yeah,
people are looking at headlines, like you said, monthly inflation figures, I mean, it's probably the internet and social media and something probably has something to do with it, because everyone's like, oh my god, but in the 2008 case in the UK that you highlighted, the Bank of England were actually quite resolute, and I remember there was a period where Mervyn King, I think, was it Mervyn King? He was sending a letter to George Osborne every day, because if they were outside of the inflation target, he had to send a letter to the Chancellor.
yeah,
The governor of the Bank of England had to send a letter to the Chancellor, and he was sending one every month because it was out of whack for about a year or so, maybe a bit longer. But
yeah,
then, like you said, with these supply side things, it came down, and if the Bank of England had increased interest rates in that period, then by the time the impact was felt, inflation would already have gone down, so it would have depressed the economy. And I get the sense that that's exactly what you're worried about
yeah,
here. There's what will happen. The trucking costs are going down now. I saw something. I think it might even have been on your feed about inflation expectations going down.
yeah,
And we're just not letting these supply side problems. The war is obviously something a bit different, but we're not letting some of these supply side problems sort themselves out, and we're just kind of doing a Thatcher and a Reagan and a Volcker and sort of nuking the economy and potentially and putting people out of jobs
yes.
in order to solve a problem which is actually caused by something quite different.
Yes, exactly. I mean, the purpose of raising interest rates is actually to increase, well, really to increase businesses' costs, to discourage them from giving inflationary pay rises. Because if you raise businesses' costs, yeah, their borrowing costs, then they can't give inflationary pay rises, or if they do, they'll have to lay some people off, won't they? So that's kind of what it's about. And I want to see where these inflationary pay rises are. There are demands for them, but so far nobody's giving in.
Yeah.
You know, in pay rises at the moment are running way below inflation.
Mm.
Um, you know, so it's not like the early 1970s, you know, when we had pay demands of 40% that employers were giving into, and you know, and very strong unions. We don't have that now. So I'm wondering, we seem to be fighting kind of last century's war, really, and not fighting the war we actually have. You see what I mean? It's unfortunate I'm talking about wars when we actually have a war. But you know, the economic war strikes me as not quite the same. That we seem to be terribly worried about the kind of wage price spiral type of accelerating inflation when there's no actual evidence of a wage price spiral. And what we are seeing is an absolutely massive supply side shock, partly because of the unwind of the COVID pandemic and the supply side disruption because of that. And now also because of a war involving an oil producer and an oil and gas, a major oil and gas producer, and two major producers of foodstuffs. That's, you know, that's bound to be inflationary. I mean,
Mm. Mm.
and it seems I'm struggling to see how raising interest rates can in any way address that. There is, you know, how is raising interest rates going to create more oil and more gas and more foodstuffs? It's not. It's just going to make it harder
Mm.
for people to. It's just going to place more pressure on households and businesses that are already struggling to pay those increased prices. I don't see the point, and I think there is a real danger that we will end up with a crash landing. Which is why I rather jokingly said the other day that I ought to write a book called "How to Land Your Helicopter,"
Mhm.
um, because
How to sort of how to
yeah,
wind down QE and how to do it
absolutely,
in a way that doesn't lead to inflation and also
yeah,
takes
absolutely.
care of people.
Or if you have got inflation, what to do about it?
Mm.
How to manage your economy so as to um, calm down excess demand without causing a recession. You know,
Mm.
we don't seem to know how to do this. I mean, the kind of shock and awe approach used by Volcker was at least partly based upon a misunderstanding about how monetary policy works anyway. Um, and it's also worth remembering that at the time that Volcker was doing his 20% interest rates, Reagan was doing massive, massive fiscal stimulus. He was doing huge tax cuts. He was ramping up defense spending.
Mm.
What Whereas what people seem to want to do at the moment is concurrent monetary tightening and fiscal tightening. Well, that's not clever at all. In that respect, I would have to say that this is a bit of a difficult thing to say, but I actually think that on balance, I think the kind of the truss approach of throwing money at the economy on the fiscal side while the central bank is raising rates is probably a better approach than the Sunak let's do fiscal responsibility and cut down and reduce the deficit and so forth at the same time as the central bank is raising interest rates, simply because I think it's likely to be less damaging to the economy. But I know
Yeah.
people are terrified about it. But from my perspective, if you're going to do pro-cyclical interest rate raises, then you need fiscal policy to be pulling in the other direction. Otherwise, you are going to cause a recession.
Yeah, yeah. I mean, I guess you kind of you were touching on it. You were beginning to touch on it with your how to land your helicopter
Yeah.
potential book, which I'd like to see and read, by the way. But I think what kind of QE for the people what do you think would be most appropriate now, if any?
Mm. Right now, I mean, you have to look at the need of your economy. Um, right now, um, central governments need to be supporting. doing some degree of protection for households and businesses from the effects of the war. We're in a wartime economy. I know the West is trying to pretend it's not a war, and I still want to say yeah, and get out my battered copy of How to Pay for the War. Uh, it's Keynes, because we are.
Mm.
Yes, even though we are not ourselves blowing up the Russians, we are. Um, we have this massive package of sanctions, and Russia's bound to retaliate to sanctions. Why wouldn't it? The sanctions are going to hurt us. They're not going to be effective if they don't. So the vast increase in gas prices and oil prices and foodstuffs is at least partly because of the sanctions that we've chosen to do as our part in fighting this war. And the other side of it is actually a slight increase in defence spending as well, because of course we are providing military aid to Ukraine, and I think that could well increase now. Now that Ukraine is showing some signs of actually making headway against Russia. So there's a cost there as well. So right now, I would say that there is a case definitely for raising interest rates, but only if the government is willing to do a lot more to support businesses and households. And I still think I'd rather look at How to Pay for the War, really. And in How to Pay for the War, it was forced saving, which is why so higher interest rates tends to encourage saving. So in How to Pay for the War, he was recommending selling more bonds. You want to have something that you can encourage people to save, so higher interest rates. And you need price controls, and that's kind of what, and we kind of are back to the realms of price and wage controls, because that's what you have in a wartime economy.
Mm.
Um, that doesn't mean you need that the rest of the time. I think one of the, everybody goes, what you're recommending prices and incomes policies, and well, kind of, but it is a war.
Yeah.
Um, I think that you can't, that the kind of policies you have in peacetime and the kind of policies you have when you have a major war in which you are involved, in which the whole of the world is involved, actually, um, one way or another, are different. And
Yeah,
maybe it's just time we recognize that what we have on our hands is something that yeah, it's not a world war as such, but it is a war in which the whole
mm.
world is involved one way or another.
Yeah, I do tend to agree with you that we we are effectively at war, right? And I think although we haven't sent troops, into Russia, we're not invading Russia, we haven't declared
Yeah,
war on them. The degree of support for Ukraine as well as the economic sanctions on Russia. I think we need to admit that we are in a wartime economy, and that goes beyond economics. But for our purposes here, what you're saying is that a wartime economy, it has rationing.
yes,
It tends to have high inflation,
yes,
and there tends to be a lot of planning and government intervention, right, in order
absolutely.
to manage these things. And we have seen that emerge, kind of ad hoc, right? As governments kind of realise that they're going to do things. But I suppose if there were a QE for the people, could you see it take the form of some kind of planning agency or something like that was supposed to manage this situation, and it may have funding from a central bank, but it might also have some other powers of of rationing and price controls and things like that. I mean, is that
Mm.
is that how you would see it going ahead?
Yeah, I think we are in the realms of my kind of QE for the people type 2, where all the action is fiscal, and the job of the central bank is to support its fiscal authority. I think that's where we are. It's where we've been through the COVID pandemic, which in its way was another kind of war. I mean, we weren't fighting a human enemy; we were fighting a virus, but we still did extraordinary things to our economies to fight this enemy, and the fiscal response was enormous and unprecedented, and it was all supported by central banks. And I think we are in the same, and I think that's also the approach you have to take in wars, that all the action is fiscal, but the job of the central bank is to watch the back of the fiscal authority, really.
Yeah, yeah. I mean, it's with fiscal policy. I mean, is QE for the people just kind of merging monetary and fiscal policy? Basically, is it sort of merging
Arguably.
them or turning one into the other, or because if you've got, I mean, there's loads of different variants of QE for the people that
Yeah,
you go into detail on, but you've got one example is the helicopter drop, right, that we've talked about a lot,
yeah.
that Biden arguably did, just
Mm.
sending people a check. The other one is to have like kind of funding of some kind of state-owned national investment bank, or something like that, or some kind of planning authority, as we were just talking about. Or you could maybe lend directly to small and medium enterprises.
Mm.
There's lots of different ways of doing it, but then when you do those, it's like, wait a minute, well, you're just spending money and
Yeah.
directly into the economy, and that's fiscal policy, right? So is it almost, I mean, would you like to see this distinction blurred, and would you like to see us think more holistically about just the central bank and the government and the money they're creating and spending and how they're doing it?
Absolutely. Yes, absolutely. I think this kind of, sort of hard separation of monetary and fiscal authorities is extremely damaging. Perhaps no, and in fact, if you try and enforce it, you end up with your monetary authority having to behave like a fiscal authority. And we've seen that in the Eurozone, where the ECB has had to do things and act in a way like a federal fiscal authority. Um, which it shouldn't be. So I think that hard and fast separation is too much. That said, I think it's nonetheless useful to have clear roles. Okay, so my separation works like this: central banks are responsible for the money. They create money, they manage money. That's what they do. Okay, interest rates are simply the price of money. Central banks deal with money. But what the fiscal authority does is deal with matters of distribution. It deals with the real economy. It deals with the businesses and the households that make up the real economy. And so where the central bank will produce the money and determine its price, it's the fiscal authority that determines how that is distributed. And therefore it's the fiscal authority, not the monetary authority ultimately, that determines inflation. Because I think inflation is, um, to a considerable extent, a matter of distribution.
Yeah.
And that's why you can end up with, is it CPI inflation or is it asset inflation? And, young people saying, um, house prices are through the roof. How can this not be inflation? It's not CPI inflation, but it is a form of inflation, and it's caused by the distribution effects of, um, well, of fiscal policy, because monetary policy left to itself, expansionary monetary policy left to itself, will tend to raise asset prices. So you need your fiscal authority to intervene to sort out the distribution.
Yeah, I think, I mean, I appreciate that. Sounds like it could be a decent separation of powers. I suppose when we talk
Yeah,
about merging monetary and fiscal policy, we don't want the result to be just undirected chaos where, everybody's
absolutely.
responsible for everything and therefore nobody's responsible for anything, right? Which may arguably is what we have right now in the UK in our response to these crises. So
Headless
yeah.
chickens, absolutely. I think, I mean, the image I had on the front of my book was inevitably kind of apocalypse now, uh, helicopter. But we did put some money, so a helicopter dropping money, which of course is a reference to Friedman. Um, And but in the book, I pointed out that the helicopters are actually, although it's the central bank that fills the helicopters with money, it's the fiscal authority that decides where the helicopters fly, that actually flies the helicopters. And that's true even with conventional QE, because conventional QE ultimately the mandate, the right to do it, and how it is done is in almost all cases decided by governments, not by central banks. I think the one exception to that is probably the ECB, which does mark its own homework.
Right.
But even then, it's still accountable to its shareholders, who are the governments.
Yeah. You know,
Um,
yeah, sorry, carry on.
but everywhere, and as I've said, also the ECB does tend to act like a quasi-fiscal authority. And it has had to involve itself in matters of distribution. So in ECB QE, for example, excluded Greece. But when they came to the pandemic
Yeah.
with the PEP program, which was another form of QE, they were just buying more assets. So governments were issuing debt like it was going out of fashion, and the ECB just hoovered it all up and said it's not QE, it's something else. It's an extraordinary pandemic intervention, and we all went, yeah, pull the other one. But they specifically included Greece in that. So Greece still isn't part of ECB QE, but it is part of ECB QE, if you see what I mean. It all depends what it's called. Uh,
Yeah, yeah. I mean, it's funny because say I think that's a really clear example of how central banking is political, right? When I mean, you mentioned in the
totally.
book that the ECB was one of the troika, right? When
Yeah.
that were involved in restructuring Greece's debts, telling them which policies to pursue. You know what I mean? And I think independent central banks. I mean, a few people in my chat have mentioned it. It there's, like you say, there's some grounds for like separation of powers, for having a mandate, for having some kind of arm's length relationship between certain authorities. But I think it just feels like since 2008, and then increasingly, and then with the eurozone crisis, then with COVID, and now with the war, central banks being kind of anything like apolitical is
Mm.
just a complete myth.
And they clearly aren't. They are political actors. It was very obvious in the Eurozone crisis that the ECB is extremely political, and necessarily so, because otherwise there's this kind of void. So the ECB was involved itself. It was part of the troika, as you say, again and again in the crises, the financial crises that rolled around the eurozone. So Greece, Ireland. It involved itself with Italy. Um, Trichet was sending out a list of demands to the Italian, to Berlusconi, saying these are all the things your government's got to do in order for us to continue to support your banks. It played the same thing with Greece in 2015. Do this and this and this, otherwise we'll break your banks, as Yanis Varoufakis put it.
Mm.
And Cyprus, I particularly remember Cyprus because the decision that was made originally was so awful, and it was made. I don't know if you remember this, Yui, in the Cyprus crisis in 2013, that the original bailout decision for Cyprus's banks would have imposed a deposit haircut on insured depositors, like a 6% haircut. All depositors, including insured ones.
Which is basically
Um,
the situation that deposit insurance, which we discussed earlier, was designed to avoid, right?
Absolutely. I mean, why bother to have deposit insurance at all if you're not going to honour it?
Yeah.
So, and if it's all well, the sovereign can't afford it, then your deposit is only as good as the ability of your sovereign to afford it. That's
Mm.
not very good, is it? And in a monetary union, I mean,
Yeah.
it actually would have fractured the monetary union. It would have basically said Cyprus was in effect not part of it. Um,
Mm.
Fortunately, but the point, it was made by very tired people in the middle of the night, because the ECB had come in at 3 in the morning and said, you have got to make a decision now, otherwise we're going to pull the emergency liquidity assistance that we're providing to Lakey Bank. And I remember thinking then, the ECB should not be able to do that, to apply pressure
Mm.
to elected governments like that. It should not be. It's not the right way to do things. Fortunately, we still do have some semblance of democracy in the EU, really, honest. Um, and so, fortunately, the decision had to go to the Cypriot Parliament, and the Parliament took one look at it and went, "No way are we passing this," and sent them back to think again. And the second iteration of the bailout plan preserved the deposit insurance and imposed a much larger haircut on large depositors who were not insured. That was problematic in itself, and in the end was probably more damaging for the Cypriot economy. But it did at least mean that you still could trust deposit insurance. Um, but it was the way in which the ECB again and again over years acted like the missing government. You know, the EU does not have a federal fiscal authority. So the ECB kind of had to act like one, which it should never have been. There's actually a point that MMT has made
Mm.
repeatedly, to be fair, that that the problem with the eurozone, the reason for the crisis and the reason why the ECB had to act in that way, was that there's a missing layer, that it needs a federal fiscal authority and it doesn't have one. And we still, I think we're still some distance from it, really. I'm not seeing any willingness, really, on the part of countries, really, to kind of unify their fiscal authorities, really much.
No,
And
I mean,
um,
yeah, I mean,
I know you'd have thought so,
sorry.
given the mess that Germany managed to make of its energy policy and the way in which it went to everywhere, to all the other countries saying, "Oh, please, could you, could you let us do this and that and the other?" And Italy and Spain were going, "You want us to do what?" They wanted them to cut their energy use, I believe, because Germany was going to have to cut its energy use, so it was only fair that Italy and Spain should do so too. And Italy and Spain kind of went, "Well, you didn't exactly, you weren't exactly cooperative when we were getting into debt trouble, were you? So why should we do that?"
Yeah, you changed your
So
tune.
yeah, I mean, there's still a lot of fractures in the eurozone. Really, it's not healed by any means, I find it hard to see what the resolution is, because it does try to create this hard separation between monetary and fiscal authority, and to my mind it fails. Um, but in a way, to create the illusion of this separation, it ties its fiscal authorities in a straitjacket. It kind of released the straitjacket a bit for a couple of years, and now it's talking about um, tightening it up again. So, and if it does that, then everybody will be doing fiscal consolidation at the same time as the ECB is raising interest rates, and we will have another eurozone recession.
That is a
I think.
frightening prospect. I
And,
mean,
and of
yeah,
course, the eurozone is at the front line in the war as well.
yes, yes, of course. Yeah,
And
it's
we
definitely
shouldn't
the most
forget that,
affected.
although Ukraine is not a member of the EU, countries on its borders are. And Ukraine is a candidate country now as well. So it's actually really quite frightening that they don't seem to have got their heads around the idea that actually concurrent monetary and fiscal tightening in a monetary union that is actually at war is perhaps not a great idea.
Yeah, yeah. So we need to reintegrate. I mean, nowhere more so than in Europe do we need
Yeah,
to reintegrate monetary and fiscal policy. I mean, you mentioned MMT. It's interesting. One of the most honest defenses I've had of inflation targeting, because MMT is known for popularizing the idea that we're basically discussing here, which is that central banks can actually create money out of nothing,
yeah,
and therefore that money could be used for social and economic good, and to benefit people directly instead of just injected into financial markets. Now, as we've discussed at some length, there are people who say this will lead to inflation.
mm,
Now, one of the most honest defenses of inflation targeting and central bank independence, which often seem to come together, I've
yeah,
seen is when people say, well, okay, the central bank can actually create money. It could actually do all these things. It could fund a green investment bank. It could do a universal
mm,
basic income for the people or something like that. But it needs to commit to be credible.
Yeah.
And this, the limit on central banks is actually a political one. So they need to commit to just being independent, to having this inflation target. Otherwise, they're basically not reliable, and somewhere down the road, the entire economy will, devolve into hyperinflation or whatever other horrible things you can imagine. So I thought that was really interesting because I've seen a shift of mainstream economists basically dismissing MMT to acknowledging that some of the things, the points they raise are right, but there's this political issue of credibility. And I guess my question is, bearing in mind people's QE, but also monetary and I guess fiscal policy more generally, um, how does the central bank commit to being credible? Because I do think this is a real problem, right? This is a real problem. We
Yeah.
can acknowledge it. But how does the central bank and the fiscal authority that they're coordinating with, how do they commit to being credible with the people's QE in this new regime?
Yeah, it's a really difficult problem actually, because I mean, as sort of another of my sound bites, I suppose, is that central banks are only as independent as politicians allow them to be. And so you could have a central bank that is trying to credibly commit to um, to being irresponsible, as Paul Krugman puts it, that suddenly finds his independence taken away because the fiscal authority is going, we can't do that. And that's hugely problematic. Or, and then on the fiscal dominance side, that a central bank that's actually trying to be monetarily responsible, um, and do the right thing and keep inflation under control is suddenly faced with an extremely profligate fiscal authority that is throwing money everywhere. And how can the central bank respond to that? Um, I mean, I've already mentioned Volcker, that was at least partly the reason for Volcker's shock and awe in the early 1980s, was actually because of an extremely profligate fiscal authority, very different from the fiscal authority that had gone before. Reagan was a different animal, and it was a hugely expansionary fiscal program at a time when inflation was through the roof because of yet again another war between two oil producers. That was the Iran-Iraq war. That one. No, so it's always the balance between the fiscal authority and the monetary authority, and I think we convinced ourselves at some point somewhere in about the early 1980s that the monetary authority could somehow, despite having no political legitimacy, um, control the fiscal authority that does. Well, there's a huge problem now, and then we end up going down this technocratic route that says you want to remove from the elected authorities any power that might enable them to actually be irresponsible, to do what they're elected to do what their electorate wants them to do. Well, how is that democratic? And then we get into questions about the democratic legitimacy of central banks. And I think this is a very dangerous route to go down, where we start talking not only about monetary policy being completely separated from the from democracy, like being run entirely by unaccountable technocrats, and we've gone a long way down that route already, to even lots of aspects of fiscal authority, fiscal policy also being separated. So we've had people talking about fiscal councils. We've got the European Commission overseeing the budgets set by elected governments. It is not. It is a real assault on democracy, actually, to
Mm,
start saying that the control of inflation is more important than fiscal authorities doing what their electorates want them to do. It's an assault on democracy, and I am not convinced that we should be giving the fight against inflation quite such primacy. Yes, there are horror stories. I mean, everybody, when I say that, people kind of stare at me in Venezuela.
yeah.
Um, Or start shouting about Zimbabwe or something.
Can
And
I just, sorry, can
yeah,
I just intervene there? Because as you might expect, it does really annoy me because, as you point out in the book, and you've pointed out ad nauseum, but obviously not enough. Hyperinflation is a very specific situation where
yeah,
a lot of big factors combine to produce an economy which essentially implodes, and that includes a lot of things like actual, destruction, in the case of war, or like kind of revolution or violence of some kind. It also tends to include a lot of foreign debt, which
yes,
obviously you can't print. That's not
mm,
the case for a lot of the richer countries. It
yeah,
might be a consideration for the poorer countries, absolutely. And there's just also, economies that suffer from hyperinflation often don't tend to be very diversified. They often
yeah.
tend to, be countries which rely on exporting raw materials and things like
Yeah.
that. So it just the notion of complete collapse, high inflation, sure, hyperinflation is complete
Yeah,
economic collapse. It's a
it's a
different
different
beast.
phenomenon.
Yeah.
And I get uneasy when I hear economists talking about accelerating inflation because I don't think they know what it means. I remember writing a post about this, was pointing out they didn't know what the third derivative was. After Gabriel Matthew pointed this out on Twitter,
Yeah, yeah.
which was quite funny. When they talk about accelerating inflation, they don't mean accelerating inflation; they mean accelerating price rises. It's not the same thing.
Mm,
Accelerating inflation is hyperinflation, when the whole thing
yes.
just shoots up. And and when that's happening, what's actually happening is that people are rejecting your currency. Um, they're rejecting it, and typically they're rejecting it externally and internally. So nobody trusts the currency. What's actually happening in Venezuela is dollarization
Mm,
and has been going on for years. So Venezuela has been in hyperinflation now for, I think, 7 years. It hasn't really come down
yeah.
much. It's still officially hyperinflation, has been for a long time. Why isn't this called? It's called. They've got massive economic destruction, of course, but people are still managing to survive. How are they doing it? It's because the economy is dollarizing. When nobody wants to use your currency becomes worthless. But that doesn't mean nobody's using money. They're just using something else.
Mm,
So in Venezuela, everybody's using the US dollar. More
yeah.
and more people are using the US dollar. In Zimbabwe, they'll use almost anything except the Zimbabwe dollar. I mean, seriously. And they've just had another bout of hyperinflation because the government tried to introduce another version of the Zimbabwe dollar, and everybody went, nope.
Yes, I saw that. Yeah, yeah. Wasn't it tethered to gold?
Nobody believed it.
Nobody believed them. That's the
I
problem.
mean,
Yeah,
I mean,
yeah.
Venezuela tried to tether theirs to oil because Venezuela, of course, is an oil
Mm.
producer. But everybody looked at that and said, "Yeah, but we know you've already mortgaged your oils to China, so we don't believe you."
I mean, it's kind of funny, but it's like it's also makes a serious point, which is that really it is about, like, trust in the
Yeah,
government, and
totally.
once that's
Yeah,
collapsed, you really have very little hope.
hyperinflation is really a political collapse. A
Mm.
political and economic collapse.
Yeah,
It's a sign that nobody's in control.
a sign of political collapse, isn't it? As well,
It
like,
is
yeah.
absolutely political and economic collapse.
Mm.
But the government is a basket case,
Yeah.
right? And the scars are lasting, and so even though you may recover from that and establish something approaching a credible government, what's in people's minds is we don't trust our government. And that's why you get things like, I don't know if you know about this, but Bulgaria had hyperinflation in 1996. Um, and the Bulgarian lev is hard pegged to the euro. I mean, really strictly pegged. It's a currency board, which means they've got to have 100% reserves of euros, and they can only the have the amount of levs in circulation that the that they have euro reserves for. That's a really, really strict, um, really, really strict monetary policy.
Mm.
And because of that, in 2014, I think it was, they had a banking crisis which brought down the government, and they didn't have a government for 6 months, so they couldn't borrow any money and they couldn't print any money because they had this currency board, really strict hard peg to the euro, um, and um, and so they couldn't pay the depositors in this bank. They couldn't honour their deposit insurance. There wasn't enough money in the fund, and the government didn't have any money, and the central bank wasn't going to print any. And I remember saying to one of my Bulgarian contacts, well, they could. I mean, it's not a huge amount of money. This surely they could just devalue the lev enough to enable them to honour their deposit insurance. And my friend went, oh no, no, there'd be riots in the streets because of the hyperinflation. It would be they would take that as a sign that um, the whole thing was going to collapse. That it was a betrayal of trust. Any interference with the value of the currency like that is taken as a betrayal of trust. Absolutely fascinating, and you begin to see kind
Yeah.
of the mindset of people who've experienced hyperinflation, how it destroys trust in the monetary authority,
Yeah.
and by extension the fiscal authority, because the monetary authority ultimately is really only an arm of the fiscal authority, and why countries like that often want to use the currency of what they perceive as a more stable country. So countries like Venezuela and Zimbabwe dollarize, and countries like Bulgaria want to join the euro.
Yeah. Yeah. So in terms of more credible monetary policy and returning to kind of people's QE, I
Mm,
have two things which I think have been mentioned, but I wanted to ask you directly about. So I'll ask them both at once, and then you can kind of do them in turn. So number one, some people have called for a kind of monetary policy in general, which involves QE,
mm,
that basically favors renewables and tries to have climate aims.
yeah.
And I know that central banks, when they originally engaged in QE, were criticised or have been criticised for buying from fossil fuel companies, buying bonds or stocks or whatever. So that there's the climate angle of people's QE. How do you think that could be put into action if you think it's a good idea? And then there's an equally radical policy, which would be like an actual UBI, a universal basic income,
Mm.
funded by central banks. So I was wondering what you thought of those two iterations of people's QE.
Okay, well, I'll take the climate one first because actually this is really important. Um, when we do conventional QE, um, central banks are constantly trying to cover their own backs by buying assets that are as safe as possible. So they don't want to take any credit risk, really. Um, they are just influencing interest rates, and they're not trying to do any kind of industrial policy. So if a central bank were to um, be actively involved in um, meeting climate objectives, it would need a mandate to do that from its government. I don't have a problem with that. I just think it needs to be democratically accountable for it.
Yeah.
I don't think these are the kinds of decisions that central banks should be making off their own bats. But I think if the government mandates a central bank to provide the resources and support in support of climate objectives, perhaps, for example, if you had a green development bank instructing the central bank to control the price of those bonds of the funding of that bank or something like that. I mean, there are a number of ways you can do this. All of that's possible. You'd have to consider how that affected the the inflation mandate if you were going to continue that, because if central banks do too much, involve themselves too much in supporting particular types of industries and businesses, then it can become very hard for them to meet their inflation target. Um,
Mm.
but fundamentally, it comes down to the same thing, that I think this separation between monetary and fiscal authority is questionable, and it's perfectly reasonable for a fiscal authority to say, yeah, we have this these climate goals. Everything depends upon that. We, as a responsible fiscal authority, need the support of our central bank to enable us to meet those goals. It's kind of, in a way, going back to the original purpose of central banks, which was not controlling inflation. It was financing the government in time of war. And, if we regard the climate agenda as another kind of war, we seem to have been discussing war a lot, don't we?
Yeah, that
But you
wasn't
can regard
intentional.
that as another kind of war. We're fighting this battle against this kind of dreadful future, and desperately trying to put in place things that delay or mitigate that, and that should be taking all of our attention, really, that we should be treating it as a kind of war. Then it's perfectly reasonable to harness the resources of the central banks to do it. And the only question is how you do that. Like I said, I don't think central banks should be doing this off their own bat. I think they should be mandated to do it by governments, and then you can have a conversation between the government and the central bank as to exactly how that fits with their inflation mandate and their full employment mandate and whatever other mandates they have been given by the government. Um, you know, and how they're going to achieve their objectives. It Central banks kind of involving themselves in what is an industrial policy does raise hackles in some quarters, because some people have this idea that governments shouldn't be picking winners and central banks shouldn't be picking winners either. But I think the climate agenda is kind of more all-encompassing than that. Really, it needs to touch every corner of our economy. So it's not picking winners. It's about radically changing everything, changing the whole basis of our economics. I mean,
Mm.
I sometimes find it incredible that the entire recorded history of economics, kind of from Adam Smith onwards, is all about fossil fuels, all of it. Um,
That's quite a radical statement.
yeah. Well, if you look at the timing,
Yeah,
it is all about fossil fuels. That we have no a kind of economic theory much before that,
yeah,
and it's all based upon the idea that we have the whole some story of human growth in the period that we have had economic theory has all been based upon fossil fuels. It's going to require a mindset shift among economists, I think, to try and imagine what an economy looks like that doesn't use fossil fuels.
yeah, yeah. No, it's really uh, cogent. I think it's just absolutely true. So I mean, yeah, monetary policy, people's QE for green aims is good, but
Yep.
definitely doesn't go far enough. On
No.
and on to pivot you onto an equally massive topic. So, what do you think about people's QE for UBI? Then, for like an ongoing payment
Yeah.
to everybody in a country every month, credited by the central bank. Is that would the central bank lose credibility? Would it cause inflation? Do you think is it doable? What do you think of
It's
that idea?
Well, I've been a long-standing supporter of UBI, as I think you know. Um, and again, it's arguably fiscal policy, but it all depends how you construct it, really. So if you treat your UBI as a floor, as an income floor, um, then you can treat it a bit like a stabilizer. That's kind of monetary policy, isn't it? I don't have a problem
Mm,
with using central bank resources to fund things like that. I think this idea that governments must always, anything that goes to people must always be funded by the fiscal authority borrowing from markets, I think is um, an unnecessary restriction, actually, on central banks. Why do we want to restrict their tools so much? Why do we want to restrict fiscal authorities so much? Um, I think what you need to look at, rather than saying this type of payment should be funded by fiscal authorities issuing debt, but this type of payment can be directly funded by central banks on some kind of arbitrary basis, or, well, that's a financial markets, so that's central banks, but that's people, so that's the fiscal authority kind of thing. I think it would be more sensible to look at the balance of saving and spending. Really, I wrote about this a long time ago, and I probably should resurrect it again. When you actually look at what government debt and money do, because they're kind of opposite sides of the same coin. So money, the medium of exchange, is what people spend now. Government debt is a promise to provide money in the future for people to spend in the future. You can regard it like that. Yeah. So when governments issue debt, so a government is spending and it issues debt, it has created money for people to spend, and the debt withdraws that money. So the whole effect is neutral. But it doesn't have to be like that, but that's typically how it's done. But what you might want to do is, rather than saying, oh, fiscal authorities have always got to issue debt so that none of their spending ever affects the money supply, because the money supply is always the province of central banks, and central banks alone must change it, and it must all be done through banks. We could revisit that and say, actually, what we need to look at is, do we want people to save, in which case we probably need more government debt, or do we want them to spend, in which case we probably need more money? And actually working out that balance is actually, if you think about it, what QE does. We just haven't kind of thought it through as to what exactly what we're doing here. It's what interest rate raises do as well. They change the balance of saving and spending. Yeah. So, and it seems to me that actually looking at how things are financed, whether they're financed by government debt or whether they're financed by central bank money creation, is simply that kind of decision. I don't think you need to stress about it. So, from a UBI, if I return to UBI for a minute, you were saying, well, that's going to be paid all the time.
Yeah.
There are a couple of ways of doing it. One is that you treat it as an income floor and you flex it, so it can vary with economic conditions. So if you need to cut spending to get people spending less, you could reduce your UBI, or you could increase it if you wanted people to spend more. Having a UBI actually as a placeholder is actually extremely useful as a means of getting money to people in emergency. There's a reason for doing that anyway. I'm not actually very keen on the flex, because I actually think that repressing the incomes of the poorest as a way of controlling inflation is barbaric. And that's what that would do. So what I would prefer to see it as being a fixed level which rises gently over time in parallel with the inflation target. Yeah. And then that acts like a stabilizer. And I don't see why that couldn't be financed by the central bank as just part of its inflation management.
Yeah. It seems to fit quite
Really.
well with inflation
Yeah,
management. And it's worth
it
saying it would
does.
probably replace some existing like welfare programs that do something kind of similar, right? Or do you would you have it on top of it?
Yeah, it's an interesting one, this, because usually when you sort of the libertarian fringe get involved in this, they want to sort of wipe out all welfare benefits and replace them with the UBI, and I'm going, no, please don't do that. Because the problem with treating a UBI like that is that it is one size fits all. It goes to everybody equally, and it's the same amount to everybody, and I like it that way. I just want it to be an amount of money that everybody gets that rises gently with inflation, and it's simply the base level of the money supply, if you like. Yeah, it's a
Yeah.
form of sovereign money.
Yeah.
It's kind of, like Monopoly. You
Yes.
pass go and you get your £200.
Yes, exactly. Yeah.
Yeah,
Okay.
and it's provided by the bank in Monopoly. uh, you know so and that's the version of it that I prefer. But then you have to look at individual needs, and individual people need more than that. Some people don't need their UBI, and you could tax it away. So I think UBI has to be combined with a progressive tax system, because otherwise it could be inflationary. Um,
Mm.
but also you will have people for whom that's nowhere near enough. And if you start raising your UBI to the level of it's enough for the neediest people in your society, it's too much for most people. It's not intended to create a society in which no one needs to work. It's meant to be a basic income. It's not meant to create everybody with a good living. So there is a case for replacing some benefits, such as the state pension. That's where I would start, actually.
Yeah.
Um, State pension, child benefits. You notice I'm talking universal benefits here.
Mm.
Um, and no, unemployment benefit is the obvious one. Um, but then you will need other benefits that go to certain people. You can't escape from that. There will still be people who need more and will have to have that benefit topped up with something else. But you could have a good look at your welfare programs and decide how much can be covered by UBI, and set your level of UBI accordingly, in my
Yeah.
view.
Yeah. I think pensions is the one that
Mm,
stood out for me
yeah.
as one. I think maybe sometimes some of the student stuff might be certainly not the
Mm.
tuition fees, but assuming they exist in our utopia.
Yeah,
But
maintenance grant though.
yeah, maintenance grant, for example,
Maintenance
things like
grant. I
that.
mean, you could
Yeah,
set your UBI. I mean, because that it should be the level of the state pension, really.
yeah,
If you
that
think
seems to
about
make
it,
sense, right? So
it's kind of
yeah,
obvious. Um, yeah. So you could actually kind of sort of benchmark it and eliminate those kind of benefits. Um, and then say, and then we look at it on a need basis.
yeah,
One of the interesting effects, though, would be to eliminate the contributory principle. And for me, that's no bad thing, because I think the contributory principle in pensions, particularly, is poisonous. This idea that you kind of sort of work for 50 years and then you have this reward of a state pension, or alternatively, that you pay into a pension, even though that's not actually how it works, it creates all manner of problems, because it's not a funded pension scheme and it isn't a reward for a lifetime of drudgery. The state pension is a payment to people who are too old to work,
yeah,
to relieve poverty. That's its function. And so the age at which somebody is too old to work is a matter of political judgment, and it can be changed. As demographics shift, so we're seeing pension ages rise because people are living longer, and they have been living, and they until the last few years they've been living healthier. In the last 10 years, we've seen that reverse a little bit as a result of some extremely stupid fiscal decisions, underfunding the health service and not doing anything about social care, is actually shortening lives. And so we're going to pay
yeah,
the price for that. That we want to raise our state pension age, but actually people aren't living any longer. Bit of a problem. Um, so the whole policy around it is quite silly, and I think the contributory principle is quite bad in pension policy. I would rather see us go back to a non-contributory principle in pension policy, and maybe then that's where you start looking at UBI as something that is people's by right, rather than it's something they have to earn.
yeah. That's absolutely. I mean,
Nobody should
it's
have
been
to.
called
Yeah,
like a citizen's dividend. Sometimes people
yeah,
call it, right? And it's like, I think, yeah, it's just by you being a citizen of this society, you deserve to not live in poverty, and that applies to
exactly.
pensioners and to
Yeah,
students
that
and
that
to everybody
everybody
else.
should have the right. Everybody should have the right to debate to live. Um, I prefer to look at it that way. And again, that's another argument for saying actually this is
Yeah,
just an amount of money which everybody receives and which rises naturally with inflation in a rather kind of Friedmanite way.
yeah, yeah. Okay, so yeah, so we've been chatting for a couple of hours, so I think
Mm.
we've kind of come to the end of it. It's been really, really interesting. We've covered pretty much everything I wanted to, and actually a lot more.
Oh, good.
I was just wondering to to finish, if you wanted to kind of plug your current book, also any potential future books, landing the helicopter that you might produce, and your blog and stuff, because I know you're around a lot talking about finance, talking about central banks, UBI, and the wide range of things. So if you just let everybody know where they can find you.
Well, my book is The Case for People's Quantitative Easing, which was published by Polity in 2019, and it's on Amazon, or if you're allergic to Amazon, then Polity Books or Wiley um, do it. Um, and I'm currently writing a book on banking, actually, called The Absolute Essentials of Banking, and I'm going to write a textbook as well, which will be
Oh
a bit
wow, well
bigger.
those both sound
Yeah.
excellent.
Yeah, but I do want to write this book called How to Land Your Helicopter, because I just think it's so. I mean, I like the title anyway, and it's another opportunity to put a helicopter on the cover, which is obviously going to be my logo.
Yeah.
Um, and also because it's necessary. What I see at the moment is a load of governments and central banks that literally that have flown helicopters for 2 or 3 for the last 2 or 3 years and have no idea how they're going to land them. I
Mm.
actually think this is quite important. How do you avoid a crash landing? How do you avoid a Volcker style crash landing when governments have to do the kind of fiscal support they're going to need to do to get through this latest crisis? No, we can't avoid that. We can't get away from it. And then, we and my blog will continue to be the place where I kind of sort of think about all sorts of things. And
Coppola comment.
yeah, yeah, Coppola comment where
Yeah.
I just kind of comment on all sorts of things, and
Yeah.
my think space where I kind of sort of mull over ideas and so forth.
Excellent.
And people are welcome to comment, and in fact the comments are really important because you know it doesn't all come out of my own head. um, that my readership is amazing, and people come up with the most amazing things, and they will have a discussion in the comments, and then I will write some more about what's come out of the comments. So it's just really important.
Yeah, no, it's always
Yeah,
fascinating how people interact with it, whether it's comments on blog posts or YouTube videos, or the live chat, which has also been
yeah,
really interesting.
or even on
Uh,
Twitter. I
yeah,
mean,
or
Twitter threads,
even
Twitter
Twitter.
threads, Twitter threads, and if I can manage to sort of keep the trolls away, then we can actually have some really good
Yeah,
discussions.
yeah, yeah.
Yeah,
Not an easy task by any means.
there are a lot of trolls on Twitter.
Oh God, yeah,
I seem to attract them like kind of, just bees to honey.
yeah. You touch on some deeply held beliefs, I suppose, is one way of putting it. Um,
I've never been
yeah,
afraid of being controversial.
no, I agree.
And sometimes and I take sides. I mean, I'm a human being. I'm not neutral. I have my own beliefs. And there are people who massively disagree with me over things I deeply believe in, and then we end up having a massive argument. It's all over Twitter, and I acquire another 10,000 followers because people just enjoy watching the fight.
Yeah, yeah. What we have a final question actually here that from the chat that I'll just ask you before we finish. But somebody just says, do you think of yourself in the direct line of a school of economics, or are you kind of your own school?
I'm definitely my own school. I don't see myself as being any particular school. I admire Keynes. Um, I admire, but I also use Friedman a lot.
Mm,
In a way, part of my life's mission has been to say these are not opposed. Um, I mean, I think we forget that one of Keynes's major works is a treatise on money. Um,
yeah,
and so and I even borrow some ideas from Austrian economics sometimes. I'm usually throwing brickbats at the extreme crypto version of it, but once in a while there'll be things in there that are important. Um, you know, Karl Menger particularly, his work's amazing. So I'm quite eclectic actually. I
mm.
wouldn't
You're a
see myself as
pluralist,
being
which
very
is what we
much,
like
yeah.
to hear on this channel.
Well, heterodox really, isn't
Mm,
that what it means?
yes. Okay. Well, yeah. Thanks again for coming on, Francis. It's been really fascinating, and thanks to everybody in chat as well. And I'm gonna finish there. So, see you all later.